Hello, investors. Thank you so much for tuning in to learn more about the Sage Investing Group's newest multifamily investment opportunity in partnership with QC Capital. My name is Jen Wang, and I'm one of the three managing partners of the Sage Investing Group. And I'm joined here today by Chris Salerno, the CEO and founder of QC Capital, and his partner, Elijah Upchurch. Hi, guys. How are you?
Doing very well. Thanks for having us.
Yeah, thank you so much
Thank
for
you.
joining and presenting on this deal for us. So today we are here to present on a 224-unit mid-rise multifamily property located in the heart of Houston, Texas. This property is to the southeast corner of the Hermann Park in Houston, and it is in the medical district of Houston and is surrounded by a lot of retail, top employers, and major traffic thoroughfares. So although this property is a Class A property that was built in 2004, it is due for some amenity, common area, and unit updates. So we are here executing a proven value add strategy to complete the renovation on the remaining 99 units, as well as common areas to take this property to the next level for our existing tenants and our future tenants as well. So we love this deal for quite a few reasons, and here are just a few of them. We love the phenomenal location, which is right near the medical complex of Houston. We love the quality of the existing tenant base and the quality of the surrounding demographic. The average income of the existing tenant at this property is $100,000 a year, which far surpasses our 3-to-1 income ratio test that we always conduct on every single property in the tenant base. We also love the incredible 2.5% fixed rate long-term debt assumption. And we love that there was a recent $2.5 million reduction in the price, which is helping to boost the returns to our investors. Right. There we go. So we are excited to get started, but before we dive into more detail, we need to take a moment to read through the disclaimer in its entirety. But I've just summarized it for now. In short, it just says that this is not an offering or solicitation to sell a security. Upon request, we will provide the private placement memorandum and the subscription agreements to you. This is an illiquid asset, and the managing partners are in no way guaranteeing the projections. So please consult with your attorney, your CPA, or personal financial advisors regarding the suitability of an investment for you. All right, so let's get started. We are going to start with some team introductions. First, a little bit about us, the Sage Investing Group. We are a multifamily real estate investment firm, which was founded by Maggie Chung, Jin Wang, which is myself, and Lana Choi. Our team currently holds a portfolio totaling over 2,400 apartment units across 5 markets. We all come from a Big Four accounting and audit background, where business risk mitigation was a big focus for us. So today, we combine that professional skill set in risk mitigation and our passion and experience in multifamily real estate investing to identify the best investment opportunities for ourselves and to share those investment opportunities with our investors. Our team, we specialize in sourcing value-add multifamily assets. For now, mostly in C-class properties, but we also see a lot of value, a lot of benefits in diversifying our portfolio with Class A and Class B value-add assets. So we are very keen on actually partnering with the right team who are experts on those A and B class assets and who are experts in the different high growth markets in the Sun Belt states. So speaking of investing with the right team, we are thrilled to be making another investment in the great state of Texas and partnering on this opportunity with Chris and Elijah and their team at QC Capital. This team has demonstrated a high degree of sophistication, thoughtfulness, and conservatism in their underwriting and business plan. So combine that with their professionalism and their ability to deliver really makes them highly regarded in our eyes as co-sponsors. and myself personally as an investor in one of their previous deals. Chris and Elijah, would you please introduce yourselves? And I'll let you take it away with a presentation on Verdir at Hermann Park.
Yes, thank you again so much for having us. Very excited. I'll give a little background about myself, the company. Elijah will dive into himself, and then we'll go ahead and get started about this wonderful opportunity that we have to present for you. My name is Chris Salerno, founder and CEO of QC Capital. I reside here in Charlotte, North Carolina for a little over 16 years. I have a son who in December. He is a handful. He's more than likely going on 6. He feels like he's going on 6 years old. He is a wild little man. Around eight and a half years ago, I got into the residential industry of real estate, ended up becoming the top broker in Charlotte. From there, I had fix and flip, single family rentals, and I created a company. I ended up merging that company with the number 1 company in the Carolinas. We're also 4th in the world with Keller Williams at that time. And I was able to bring them from being in a position of their COO from 92 million in annual sales all the way up to 147 million just in a year and a half. After doing so, I felt like I hit a ceiling. I was paying way too much in taxes, and I wanted to find a way to limit my tax bill that I was paying out and then also build wealth of owning real estate. And that is when QC Capital was formed towards the end of 2018, the beginning of 2019. Since inception, for less than 3 years, we've accumulated a little over 200 million worth of real estate and also over 1,000 units in our portfolio. We're very excited about this opportunity and to also partner with Durek Family Office, which is a fairly large family office, which owns over 5,200 units, or excuse me, over 6,200 units just in the Houston market alone. He has roughly over 7,800, almost 8,000 units in the Southeast. Very knowledgeable on this asset and in the Houston market as well. I'll go ahead and give it off to Elijah to give a little background about himself, and then we'll dive deep into this presentation.
Yeah, thanks, Chris. My name is Elijah Upchurch. Most people call me Eli, a little bit easier out of the mouth. I fell in love with commercial real estate pretty early on after searching through a bunch of the different asset classes, stocks, bonds, things like that. Quickly found commercial real estate to be really, in my opinion, the best asset class for an investment, and meets a lot of desires that investors have. So I committed to it. I spent a few years at a private equity firm out of Dallas. When I joined, they had $1 billion in assets under management. And by the time I left, they had $3 billion in assets under management. So I saw a ton of growth at that company. I managed just over $200 million personally in assets, mostly in multifamily, a little bit of hospitality, a little bit of development. Met up with Chris about halfway through my tenure there. We started to sort of bounce ideas off of each other, help each other out where we could. If you guys know Chris, he's kind of a freak of nature, a workhorse, right? He was doing everything himself, of course, doing everything himself. I joined, and it turned out that we filled a lot of each other's weaknesses, and our strengths sort of compounded. And so we bought our first deal together and decided to join a partnership, really make QC Capital the thing that we've always dreamt of it being. And that is the journey we're on now. I've been here for about 3 years now.
Thank you so much for that, Eli. We'll go ahead and dive into our presentation. Table of contents. This just breaks down each slide and where you can locate individual topics for this presentation. Exclusive summary. Before I dive deep into this exclusive summary, wanted to give you a little background on how we located this particular opportunity. This market has been extremely difficult if you're in it, if you're in the stock market, if you're looking to invest. And when it comes to finding great opportunities, they're like a needle in a haystack these days. And thankfully, we found that needle in the haystack. I definitely have to give it to Elijah and the acquisition team for really working hard and following up with our relationships with our brokers. Our director of acquisitions has a very strict system that he follows up with brokers. And we actually initially submitted on this property at the end of Q1, beginning of Q2 of this year. This property was bundled up in a portfolio, which means multiple properties are being sold at once. This was one of one of four, so 4 properties total. And when we were analyzing it, our director of acquisitions really became a capital markets wizard. And that means just really focusing on the markets in general, what's happening in the markets, and trying to predict the future. Well, they were spot on in regards to knowing not to go bridge. Bridge is a certain type of loan that is a little riskier. It's higher leverage. So at the very beginning of the year, and it's also a floating rate, which means your rate floats. You can buy a cap, but your rate floats, which creates that risk. But you get the higher leverage compared to a fixed rate or a fixed rate type of debt. However, we were analyzing this portfolio. We knew that the bridge market was very risky. So we started to analyze it, and we just wanted this one property. There's another group that beat us out and took down the whole property. Well, when they did that, they actually had to back out. They lost their earnest money, and they had to back out because the bridge market was too volatile. Well, with our systems and our director of acquisitions, his follow-up process, he followed up with the broker while looking at another deal with the broker, and they said, well, the deal fell through. Seller doesn't want to sell. We said, well, we would love to go after Verdir because Verdir is a loan assumption. So we are actually just assuming the loan, which means basically the seller is signing off and we're putting our name on the loan at a 2.5% interest rate HUD loan. Now, if you know HUD, HUD has two different type of options, whereas it is a rent control property or it's a green initiative, meaning the property has been certified as a green initiative, which this property is all market rent, but it is a certified green initiative property, so it passes those standards, which is very, very helpful because we're able to get the HUD loan at that 2.5% interest rate. That's how we were able to acquire this or get this property under contract, which our expectation of closing is December. So we do plan on closing in December of this year prior to the new year, and we'll get in later into more details on that. But that's how we acquired it. We're very excited about this opportunity, and let's go ahead and get started. Exclusive summary. So this is a breakdown on the left-hand side. I don't want to read it word for word, but I'll just summarize it. It's a 224 units built in 2004. It has a mixture of 1 bedroom, 2 bedrooms, and 3 bedrooms. You can get an idea of it. It's in the medical center of Houston, which is one of the largest medical centers in the United States. Has been very strong during any type of market correction. And also this property has been extremely strong as it's been 100% collected over the past 12 months. They haven't had any issues with their collections. Very similar as the opportunity that we recently partnered on in San Antonio, Jen and I, which that is also 100% collected next to a medical center. So we like these assets that sit next to a medical center. The average median income for this particular asset for all the tenants is $100,000, which is very large. Normally you see anything from $50,000 to $70,000, but this particular asset, it's just $100,000. So people are paying rent and they can afford it as well. On the right side, you'll just see a high-level breakdown. Purchase price, we're acquiring it at a $44.2 million, which is a $2.8 million off of our initial purchase price, which was initially $47 million at the very beginning. We are assuming a loan. Year built is 2004. Acres is 2.66. Total of units is 224. Then it breaks down to square footage, average rent for the units, average square feet, and our current occupancy. We're going into 4 reasons why we truly love this deal. Cash flow, average cash on cash is around 6%, 70% break even, meaning that the property would have to get down to 70% to just break even, cover all expenses, cover debt services. So it's very, very low. We like that number. We like to take a look at that number. We've seen deals in the high 80s, which means it's bringing on some more risk. However, this deal is at 70% break even. Demand heavy micro markets. Elijah, do you want to touch on this topic? Because I know you like it.
Absolutely. If you guys were on our discussion about Pilates, you know, we love this called RDM. stands are being constructed in the radius, a certain radius around the asset, usually 2 to 3 miles. And we compare that to the amount of new renters, not only new citizens, but actually new renters expected to come into the market in the 3 to
your Wi-Fi is going in and out.
and being built now. Okay, can you guys hear me okay now?
We can hear you.
Better?
Yes.
Okay. As I left off, this is a comparison between how many renters are coming in versus how many new units are being constructed. And in a normal sort of urban area like Houston, in a major primary market, we're happy if we break even, right? One new renter coming in for every one new unit being built. Well, in this scenario, we actually have 6.37 new renters coming in for every one unit being built. Simple supply-demand dynamics. The more renters there are, less units there are, the more demand we're going to have, and the higher the rents are going to go. So this is amazing for us. Another great metric here is that there are high absorption rates, which tells us how many people are actually renting the current units that are already existing. And that tells us that because there are high absorption rates and people are absorbing these units pretty frequently, that demand is outpacing supply. So it's already demand heavy, and it's only going to get stronger as we go forward. So we're really excited about that.
Perfect. Thank you. All right, another 2 more. Low default risk, fixed debt. It's not floating. It is fixed debt at 2.5% right now at a 65% LTV. Low leverage when it comes to debt, delta multiple. Flexibility. It's long-term debt. We have 28 and a half years left on this debt. There is a 99% chance for our succession of our business plan. We are going to look to sell. We are not more than likely going to look to refi because the debt is so good. We're going to look to sell. And there's more 99% chance that the next buyer is going to take over our debt. So they're going to assume our debt as well, because that means we're going to have around 24 years left on the loan. And so it's going to be well positioned for that buyer to assume the debt because it's at 2.5% for the next 24 years. So keep that in mind. Low fee to sell for 10 years. These returns that we have in here do factor in a sell where we are having to pay that fee. Keep in mind with that loan assumption that will be knocked out. So the returns will increase due to that. Our structure. So for those that have partnered with us previously, we've done a Class A and a Class B structure. We just rolled out a Class C structure, which a lot of our investors are really liking at the moment. And let's dive deep into those and in the breakdown of it. Class A is a minimum of $100,000 investment. And that is a 9% preferred return. So that if you invest $100,000, you're going to receive $9,000 annually with monthly distributions, as we provide monthly distributions and also monthly update. This is going to be quarterly distributions with monthly and quarterly updates as well. The 9% is no upside. So you just receive that 9%. On that annual basis, you receive no upside, so no participate in the profits. However, you do have priority in cash flow. Class B is a minimum of a $50,000 investment. That is a 7% preferred return. So, for example, if you were investing $100,000, you would receive $7,000 annually. If it was $50,000, it would be half of that, which is $3,500. And that 7%. After 7% preferred return has been hit, the next hurdle is a 70-30 split up until a 13% IRR. Anything after a 13% IRR, it is then a 50-50 split thereafter. You are participating in the sale of the property, whereas in Class A, you have that priority in cash flow, but you do not participate in the profits, where Class B and Class C, you do. Class C is a minimum of a $250,000 investment. That particular opportunity is very similar to Class B, but a little change. You still have that 7% preferred return annually. It's after 7%, it's an 84-16 split. So 84 in the investor favor, 16 to the GP team, up until a 13% IRR. Anything after 13% IRR, it's a 60-40 split, 60% into the investor favor and 40% into the GP team. You can mix and match. You just have to hit the minimum requirement of the class that you're participating in. So for example, if you want part of class A, you have to have the minimum of 100. However, you can do 50,000 in class B and 50,000 in class A. If you would like to participate in class C, it has to be a minimum of 250. You can do 200 in class C and then 50,000 in class B. So that gives you an idea of the structure. You can mix and match. I encourage you to read it through detail. Let us know if you have any questions. We're more than happy to answer that. Our next breakdown is just breaking down the structure on the right side of the classes and how that's structured. On the left side, it's breaking down where you can see all the capital is going to. So our debt is around 28.9 million. Our equity is 27 million. Our general partner has 30% ownership, whereas our limited partner, which is our investing partners, have 70% ownership, and it's broken down where it's Class A, Class B, and then Class C. So you can get a better idea of the structure and the classes, the level and the tiers of them. Keep in mind, for Class B and Class C, the property's expected to produce around 4 to 5% year one in cash flow. And we get this question a lot. Whereas, well, if the property is producing 4% and we're a 7%, where's the 3% delta made up? And so what happens is that 3% delta, for easy numbers, if it's 4% year one in cash flow, that extra 3% is accrued, meaning it's going to get tacked on to the second year. We really see the 7% pref across the board being caught up when we sell the property. We're definitely going to try to hit it throughout our business strategy. Year one is always a little lower because we're implementing our business plan. We're going in, we're renovating, we're putting our business plan to use. And so year one's cash flow is always a little lower. And then we expect that to year 2, 3, and 4 to pick up with the sale in year 4. So below are the sample structures based off of 100 or based off of the minimum investment. So the minimum investment that we have for each of the classes, we'll go in and see the top one, top tier, which is Class A. That is the 9% preferred return with no upside. So you can see that with a $100,000 investment, you'll receive that 9% annually up until year 4. Year 4, you'll receive your initial investment back plus that year to date of that 9%. And that total amount is not including your distributions of the 9% in year 1 through 3. So keep that in mind. Class B, you can see it's the minimum $50,000 investment. You can see where year 1's cash flow is a little lower, 2 and 3. All that's going to be accrued and caught up. You can see the years of the cash flow and then the total to the bottom right hand of the graph on what is expected from the sale of the property with your initial investment coming back. Class C, which, like I've said, is our most exciting class. A lot of appetite from investing partners on this particular class because you do have a larger split in your favor, whereas a minimum investment is of $250,000. You can see the year 1, the year 2, and then year 3, what our projected cash flow percentages is. And then year 4, you can see at the very bottom, the overall return of investment, including the $250 as your initial investment. Any questions with these slides, don't hesitate to reach out to Jen or myself. I encourage you to go through them deeply. There may be some questions, so would love to answer those. A sensitivity return summary. So we'll go we'll summarize this. The sensitivity return summary, we like to break it down you can see off of cap rate. Cap rate is when we sell the property, and that fluctuates our returns. And as you can see on the left-hand column under cap rate for Class A, it does not affect it because they are just receiving that 9% with no upside in their initial investment back. But as you can see, Class B and Class C to the left-hand side, and looking at the column with cap rate, as the cap rates go lower and decrease, the higher the returns are for the investing partners. As the cap rates increase upon sale, the lower the returns are for the investing partners. So you can get a good idea based off of the cap rate. If it's a lower cap rate, what your return will be back, including your initial investment. So on the returns on your deposition, you'll see that it includes your initial investment and then your return on top of that. One thing I really like to look for when I'm making personal investments as well is equity multiple. What is my equity multiple amongst that time frame that particular operator is looking to hold the property? IRR, it's a good metric. However, it really takes into consideration time, which can be fluctuated drastically if we sell in 2 years compared to selling in 6 years, for example. Your IRR can be drastically fluctuated. So I really like to take a look at what is my equity multiple, and that is basically saying if I invest $100,000 and my equity multiple is, for example, 1.76, I'm going to receive $76,000 on top of my initial $100,000 investment because it's a 1.76. If it's a 1.5x, that means I would receive on a $100,000 investment $50,000 on top of my initial $100,000 investment. So it's really easy to calculate the returns, whereas IRR plays into consideration time, which can fluctuate pretty drastically. Class C, as a minimum investment of $250, you can get an idea based off of a lower cap rate, a higher cap rate, what your potential returns can be as well under the return column right there. You'll also see the IRR, equity multiple, and cash on cash. Investment offering, just another summary. This is Verdir at Hermann Park in the Houston's Medical Center, which is a phenomenal medical center. It's walking distance to Hermann Park, a couple minutes from the downtown medical center, and then it overlooks, the property actually overlooks, which we do charge premiums for those particular units, the city of Houston itself. So if you know Houston, Houston's very big geographically. However, this property is well located, and that's something we've learned and something I've learned in the residential industry and then also the commercial industry is location, location, location. It matters tremendously. But this is just a picture of the interior corridors, which we plan on really sprucing up and putting some more modern feel to it. Another high-level overview of the breakdown, 224 units. Average unit square foot is 975, built in 2004. Occupancy at the moment is 88% with 100% collections, 2.66 acres, and we'll dive into what that other slide looks like of the layout of the property. This is approximate retail recreations that is in a approximate miles to Verdir Hermann Park. When we really look at assets, we like to analyze the assets on where they located in proximity to retail, to outdoor activities, also to Starbucks and Chick-fil-A's. Those are two prominent locations, and I just saw on a ranking that Chick-fil-A ranked #1 for restaurants in the United States by individuals, and then Starbucks was #2. We like to piggyback on their research because they do tremendous amount of research when it comes to demographic, especially Starbucks, paying $6 to $7 for a cup of coffee. They want to make sure they're in a great location, and same with Chick-fil-A. They are going to be in great locations, so it passes our Chick-fil-A and Starbucks text or our Starbucks test, where those two prominent companies are in very close proximity to Verdir Hermann Park. I encourage you to take a look at this slide. It just breaks down where the malls are, golf courses, zoos, some attractions. Unit mix. This is the unit mix currently at Verdir. It's a great variety. We really like to see the unit mix be open and fluent through the 1, 2s, and 3 bedrooms. I won't go through line by line, but you can get an idea of the different type of unit mixes, how many units of those mixes are at this asset, the square footage, the rent per square foot, and then also rent for the units. This is another great breakdown. This is a lot easier for my eyes. A great breakdown when it comes to the percentage of the current property and the unit mixes. Community amenities. Going into our business plan, want to discuss this as it's super important. As Jen said, this property is 2004 built, and it still has value-add components there. We did a very thorough due diligence inspection of every single unit, all 224. And we noticed 114 units were already renovated to our scope of renovation, whereas 99 units still needed to be renovated to the scope. So they were classic units, we would call them. Our business plan is to take those 99 units and bring them up to where the 114 units are currently at, with white cabinets, backsplash, gray walls, gray and white granite quartz countertops. It already has stainless steel appliances, which is great. Saves us CapEx and renovation dollars. And so really sprucing up that interior. When it comes to the exterior, we plan on replacing the roof, exterior touch-ups on the stucco, and possibly paint. Enhance the community center. As you'll see, if you look directly under the community amenities, you'll see the computer. That is their computer workstation. You can see the background of that, where it's that cream wood type of color that was very popular in 2004. As of now, we are seeing the trend of the white, the gray, really spruce up that modern feel in these apartment complexes. That's what we're seeing, and that's what we're seeing tenants love compared to that older feel. So we plan on going in, renovating the clubhouse, the exterior, really enhancing it, making it that modern feel. As you see on a couple slides coming up, the property sits on top of the parking garage. So it's all interior. You'll take an elevator to your floor and then go access your unit. Well, when you take that elevator to your floor, that is the interior corridors, which we are going to really spruce that up, make it and feel luxurious, maybe that hotel, Four Seasons, Ritz-Carlton feel with LED light fixtures, new paint, new carpet. That's another selling point, and it's another point that when you show a potential tenant, they go through that and they see that before they even see the unit. So really sprucing that up will help sell the interiors tremendously to achieve our rental premiums. I encourage you to take a look and read every bullet point for this particular slide on what we plan on doing when it comes to the community amenities. Property profile. We're going to dive into some of the property details, unit mix, amenities, property specifications, and floor plans. Going over this, I'll summarize it. I won't go line by line. We've said this in a couple slides prior. Year built 2004. The stories is a 4-story mid-rise with a 1-story clubhouse. We also have a 2-car parking deck, which I'll show you, or won't show you the parking deck, but we'll show you the layout of the property itself. You can see the roof system is a flat roof coating with asphalt shingles. Roof is 6 years old. Exterior is brick and stucco. And then you can dive in a little more of the framing, wiring, plumbing, and water and sewer for the property. Parking spaces, we have 403 parking spaces for this particular asset. Floor plans. And you love this because you can also get an idea of how the current properties and the current floor plans are. You'll see with the floors, they're the brown. You can see with the walls, they're creamy, not the full gray, but they're outdated. It's that 2004 feel and look of the property. This is a unit that has not been renovated. You can get an idea of the dark floors, the cabinets, or is that just the wood and no finishes. We plan to go ahead and make those white, do a white tile backsplash, and then the white gray countertops as well. Really spruce it up, give it that modern feel, modern look. Here's another picture of the interiors that you can get an idea of on what it currently looks like in the conditions. Still great. However, throwing paint, throwing backsplash really makes a whole difference on how the units look. And it really helps you when you are increasing the rents to our competitors. Really helps you and helps the leasing agent sell these units. Site plan. This is what I was discussing a little bit ago on the site plan of how the whole property is laid out. You can see to the far left, you have a couple parking spots. Those are for potential residents, for any service and vendors, and also our property management team. You can see to the bottom left, you have the pool and then the clubhouse. To the right are all the units, and then in the middles you'll see the two exterior but interior corridors and common areas for our tenants. Below this whole property sits the parking deck. Is a two-story parking deck with the 403 spaces. So they actually pull in to the right side of that main parking entrance and guest parking. To the right side of that is a little opening. They'll pull in and they go and park beneath the property. Great thing is that for this asset, parking spaces that are closer to the elevators tend to be reserved. We can charge for that type of parking. So that's always good. That's extra revenue to the property, which increases the value of the overall property. Financial analysis. I'll go ahead and let Elijah dive deep and take this away.
Absolutely. Thanks, Chris. So similar to many of the other slides here, there's a lot of information, and I want to try to summarize it. I don't know if Chris has mentioned, but if we maybe brush over anything you want a little bit more detail on, or if something is just not on the slide that you want information on, we have a chat box on the side and QA as well. Be sure to ask questions there. We're happy to answer them. Or if you want to reach out to us afterwards, we can answer them as well there. So kind of working down here, we have cap rate at the top. We're buying at a 3.9 cap rate in Med Center Houston. Really love this aspect of the deal. Expense ratio. This is calculated as the expense percentage of the gross potential rent. So we typically like to be anywhere from about 30% to about 60%. We're right there in the middle at 46%. So feeling good there. Kind of coming down here, DSCR is good. We already have our loan locked in. And I think that's about it for this slide. Let me go ahead and move on to the next one. A little bit more information on our debt. We've talked about this a ton, but we have about 65% LTV. For context, these bridge loans that are a bit higher leveraged, a bit more aggressive, usually sit anywhere from 75 to 85 or 80% of LTV, sometimes higher. And then sort of the more mild, very cash heavy, lower leverage deals are usually about 50%. So we sit right in the middle where we're getting some upside, but we're really not getting a lot of risk. And I think we're willing to take a little bit, higher debt at 65% because our interest rate is so low, and that sort of makes that risk profile much better in our eyes. So we have 28 years left on the loan, which is amazing. What this tells us, not that, obviously we're not going to hold this for 28 years, but what this does allow is it allows the next buyer to assume this loan as well. So we expect that interest rates are going to continue to rise over the next few years. They should stabilize at some point, but when we look to sell, we highly doubt that interest rates are going to be around 2.5%. So we expect that the next buyer is going to assume this loan, which will actually make our numbers even better because we've assumed the next buyer is going to get their own loan and we will have to pay a prepayment. But in reality, that's probably not going to be the case. We're going to be able to luck out there if everything goes according to plan. But, kind of moving down, fixed rate, tremendous. And then the prepayment, as I mentioned, we're at 5% in year 4. So it's a step down, starts at 8, 7, 6, 5, and then 4, 3, 2, 1 after that. But again, if the next buyer assumes the loan, we don't have to pay the prepayment penalty. We're excited about that. Pro forma projections, a lot of data here. I will try not to bore you. Let me go over the main parts here. So I think the number one thing you want to look at is how we are capitalizing on the opportunity, right? And so you'll look here in the first 3 lines, right? We have gross potential rent, which is the amount of rent that you can get if every unit was rented to market. Below that, you have loss to lease, which is the rent that you're losing to what they could be, to where the rents could be at the market. I'll explain that more in a second. And then we have our renovation premiums, which is what we believe we're going to get from actually renovating the units and essentially changing the market rent. So let's work down here. So loss to lease. Let's say that you have a unit that if you rented it today, you can get $1,000 for the rent, but you rented it 2 months ago and you rented it for $950. And that lease is now stuck for the next 12 months. And so you have a $50 loss to lease because 2 months ago, the rent was $950. Now it's $1,000, right? And so you have a loss to lease. But as you can see, that's not necessarily a bad thing, because what happened is when you rented it, it was $950. You increased it to $1,000. The market grew. You just have to wait to capitalize on that rent increase. Well, that's exactly what we've seen in Houston. We've seen double-digit rent increases over the past 3 years, and there's a ton of loss to lease that we can capitalize on as these units turn. Now, these loss to lease numbers are very high, so we're not going to do them all at once. Like within the first 12 months, as soon as every tenant turns, we're not going to increase the rent by an insane amount. So we're expecting to do this over the course of 3 years to sort of stabilize it out and make sure that we're taking care of the renters as well. And then renovation premiums as well. So where loss to lease is where the current units could be if we didn't touch them. Renovation premiums are where we can get the units to once we change them. Once we add in the agreeable gray, change the flooring, change the paint, the market rate now changes. And so we get to add that on as well. So you can see we're breaking the loss to lease down over about 3 years to where it stabilizes at about 0.5%. And the end of year 3, year 4, and the renovation premium is very similar as well. We end our renovations towards the middle of year 3. So very conservative there. We think we could probably take this down in 12 to 24 months, but we wanted to push it out for 36 months to be as conservative as possible. Going down from there, let's look at expenses. Another prime example here. I always say that the 2 main things you have to look at are debt and taxes. So let's look at taxes here. Property taxes on 12 was $806,000. For those of you who don't know, these taxes reassess at sale. So once we acquire the property, the taxes will change, and we use a third-party tax professional who knows the tax code in every single state to assist us in our tax projections. And we see that it's going to increase by about 20% in year 1, which is normal, and then sort of stabilize from there on out. So we have the payroll we are going to increase. We've gotten a lot of questions on why we think why payroll is increasing so much. Our argument is this: we want to make sure that the property performs well, and that starts with people. That starts with good employees, good management, good maintenance supervisors. And so we want to spend money on good people and make sure that there are enough people. I think currently at the property, there aren't enough people, and we think we can add some more in there to make the property run a bit smoother. Our property manager agrees, the one that we're using. We also got this vetted by another third-party property manager that is one of the biggest property managers in the world. They said the exact same thing. So we're really excited about this. This is a minor expense that we have to pay that will allow us to get these incomes that we want to get, and we're really excited about putting that in place. Other than that, everything mostly stays the same. We have a discrepancy here in utilities. I want to make sure this is cleared up. So if we look at T12 utilities here, they're at $93,000 on the left side, and then if we go to year 1, they're at $260,000. That increase isn't as dramatic as we may think, and the reason why is because RUBS, so this is up in the income line above other income here, is $28,000 for T12, where in year 1 we're getting $163,000 in income. So in one scenario, there's low expenses but also low income. In another scenario, there's higher income but also higher expenses, and they end up negating out. It's just a category accounting situation that we decided to change, but ultimately we're staying about the same as what T12 was. So don't worry about that. We're in a good spot there. I'm going to move on here. Rent comps here. Let's look at these rent comps. Look, all of our rent comps are within 2 miles of the property. They're all, around the same year built, except for Vantage Medicine in here. But let's look at the average rent per unit. So we are sitting at $13.92 in rent per unit on average. Let's go to Med Center, right? A 2017 build, obviously much newer, but with renovations, we think we can get much closer to where that sits. That is at $2,383, $2,383 compared to our $1,400 in current rent. Let's work our way down. Another 2003 built deal is $1,950 per unit, $1,867, $1,783. We can see here that there's plenty of growth. This is why loss lease has been high. This is why absorption rates are high. We know that this market is strong, and we know that there's plenty of room for growth, and it's proven here again through the rent comps. Sensitivity analysis. This is basically another look at our break even. So what we're saying here is at what occupancy does our income not get to a point where we can't pay our expenses and pay our debt? And we told you at the beginning it was around 70%, and we can see here at about 75%, we're still just over our expenses, and then about 65% is when we just go under the total expenses. So in other words, we can get down to an occupancy of 70%, which is pretty severe, and still be able to pay our debt. Another thing that we love about this deal. And then on the right, we have our cap rate sensitivity as well, showing what the IRR could be based on our projections. If everything goes according to the pro forma, what our IRR would be at different exit cap rates. Another picture here. I might pass it back on to Chris. Yes, I think I'm gonna pass it back on to Chris here.
Perfect. Thank you so much for that, Eli. So we're going to run through our market overview and target demographics. I won't read every word for word, but I definitely encourage you, if you're not familiar with Houston, or if you are familiar with Houston, you might learn something extra. I always do when I come to these slides that, there's always something being developed. There's always something new coming to each city. So it's it's fun and exciting to read through these. So just the overview, high level overview, 7% for 2022 rent growth year over year for Class A assets, 1.5% average annual population growth, 5.2% year over year labor participation growth, and 4.9% 5-year average net absorption. So some great numbers that we've seen there for Houston. Keep in mind, Houston geographically is huge. Here in the medical center, it's a wonderful pocket. Everyone wants to be there. You have your doctors, your physicians, your medical professionals that are all there. You can take to the right side under Houston, supply and demand and demographics. I definitely encourage you to read through that. That's just breaking down the supply, demand for that particular area, the demographics as well, and then about Houston relating to the United States and other markets. Major employers, you've heard me say multiple times, medical center. You can see to the left hand under Houston's major employers. You can see Texas Medical Center at 106, downtown Houston at 169, and then it goes down to a lot of your health and medical professionals and companies. This property sits between both of those, so it's a great location and proximity to downtown Houston, and then also to Texas Medical Center. It's in walking distance to there, so that's why the majority of our current tenant base is medical professionals, which is earning average $100,000 annually. So they're paying their rent, which is great. And during any type of market correction, medical has been known to stay extremely strong. This is an aerial view. If you look if you're looking at the map, if you look dead center in the middle of the map, you'll see it says Texas Medical Center, 100K jobs, 60K students. And then right when you finish the students to your top right, you'll see Verdir at Hermann Park. That's where Verdir at Hermann Park sits, right off of that 288 corridor that goes directly into the city or downtown of Houston. To the right side, or upper right hand of the picture, you'll see University of Houston, 45K students, Texas Southern University, 11K students. And if you're going back down to Hermann Park right there to the left side, you'll see where it's kind of a little gray, a little light, Hermann Park, 445 acres. So it's walking distance to Verdir Hermann Park. Great location where this property sits, and you have access to everything you need. Going back, this is what the clubhouse interior looks like. It has that 04, 05 early to mid 2000s type of feel when this was in style. Now it's not in style. Now it's the all gray, white, really making it modern. So we're planning on going in there and really enhancing the interior, which will help overall potential tenants and also current tenants really love their location, want to work here. From what we hear from the current on-site property management team, this gets utilized quite frequently. So it's going to be important to make sure that we enhance it and spruce it up. Portfolio and case study. These are our 4 current assets that we've sold last year, all for an average of all for an average of a 24-month hold period. Very excited that we were able to acquire these deals in 2019 and sell those in the middle towards the end of last year. And then Lionsgate we sold about 2 months ago, which netted our investors north of a 38% IRR for their 18-month hold investment. Another picture of the interior. This one gives a little more pop to it compared to the other side of the clubhouse, but we really plan on sprucing this up. From what we're hearing, it does get utilized by tenants, and so it's going to be helpful for current tenants and potential tenants when we really spruce up the interior. Index property management, real estate terms and definitions, and sponsorship teams. This is a breakdown of QC Capital and Durek Family Office's track record. You can see a lot of these assets are in Houston, fairly large assets. This does need to be updated because we have closed deals since then. However, you can see that a lot of these properties are in Houston and they are larger assets. So we're very excited to partner with Durek Family Office on this particular opportunity again, and we're very excited to get into the medical center of Houston. QC Capital's returns, I highly recommend you taking a look at this. These are our breakdown of our returns on what we've netted our investors based off of our projection IRRs. And those were the 4 deals that were on the previous slide that I touched and went over. Wood Partners, it's super important to have a proactive, determined, well-strategized property management company. Wood Partners, also known as Wood Residential, is the largest developer for multifamily in the United States. They partner with your large banks, your large private equity institutions, insurance companies that you guys have all heard of. We love to utilize them because they're extremely detailed, and we've worked with them on our previous asset that Jen and I partnered on in San Antonio. They come to the ball game with their hat on, ready to go, ready to play, and it helps because they are implementing our business strategy. So we have a business plan that we've discussed. We then give that to them and say, let's implement this together, and they make sure that it's being implemented. Also, our team and our asset management team at QC make sure that they're implementing the business plan and strategy for a successful overall deal. One thing that I truly love about Wood, there's multiple things, but one thing that really pops out and that we do as well is right when we get the deal under contract and we go through our due diligence, we put our selling hat on. What do we need to do and how do we need to get this property to look, feel, and operate to achieve our numbers when we sell? That buyer, what are they going to possibly look for? What do we need to do to make sure it's a nice, smooth transaction? They are on that same page with us. I think that's what helps and aligns our relationship. We've known Wood for quite a while. We've known our contact there, Cole Haley, for around 3.5 years. So ever since inception of QC, that we've had a relationship with them. So we've had a great relationship with them. They primarily focus on newer type of assets, which has been extremely helpful. Real estate terms and definitions. There may have been some times throughout this whole presentation that you may have scratched your head and said, Chris, Eli, what's cash on cash, or what's equity multiple? What's cash flow? What's cap rate? I encourage you to take a look at this slide, read it through detail. If you have any questions, please reach out to us. But it will help you, and it's the definitions to some of those verbiages and words that we've used and throughout this whole presentation. So I definitely encourage you to take a look at that and read through it. And for there, I'll go ahead and let Jen take it over.
Thank you, guys. Thank you so much for such a wonderful, thorough presentation on Verdir at Hermann Park. So I would like to wrap up the investor webinar by just going over the post-acquisition expectations, the next steps, and some top investor questions that we have gathered for Chris and Elijah to address for us. So as an investor, you can expect to receive monthly updates and quarterly financials from us on this investment. And Chris, you said earlier this is quarterly distribution, or is it monthly distribution?
We provide monthly distributions.
Okay, perfect. Yes. So you'll also receive monthly distributions beginning in the second quarter, which is typically 90 days after closing. And as you know, investors are an important part of our business. And these projects would not be possible without you guys. So we value your partnership, and we strive not only to meet your investment goals, but to also provide a great experience along the way for you guys. So we will communicate any challenges that we come across, and we're always available via phone or email to answer any of your questions about the project or the investment. Is it clicking? There you go. So the investor documents, they are now available in the Invest Next portal. You'll need to review these documents and complete the investment package, which contains the offering documents. Once we review and approve them, we'll let you know when you can wire in your funds. The deadline for funding the deal is the 30th of November. So this is an incredible deal, as you all were able to hear and learn about, with amazing debt terms. So we do expect that this offering will fill up quickly. We do accept investments on a first-come, first-served basis based on when those funds are received. So even if you fill out your paperwork in the portal, your investment is not secured until your funds are received. And we, as Chris has said, we plan on closing the week of December 21st for this particular deal. The minimum investment amount is $50,000. And the offering is open to accredited investors with some space for non-accredited investors. If you are non-accredited and you are interested, please reach out directly to us and we can walk you through that. We are accepting investments from IRAs, solo 401ks, EQRP, trusts, and LLCs. And finally, we're managing through this, like I said, through the Invest Next portal, which is different from our usual syndication pro portal for many of you. So you will need to register for an account, and then you should be able to log in and see the offering and make your investment. All right. So now we have a few additional questions for Chris and Elijah as part of our Q&A session asked on behalf of our investors. Are you guys ready?
Yes, let's do it.
All right. So first of all, we didn't really talk about the cost segregation. And as we all know, 2022 is the last year for the 100% bonus depreciation. So can you guys just talk about what we can expect to see on that cost segregation study?
Yeah, so we're right now we are still finalizing that with that final number. Right now, the average on what we're looking at for our cost seg is anywhere from 35 to 60% for year one. So that's what we're looking at right now at the moment, and we're still finalizing that. But once we get that finalized, we'll definitely let you know.
All right, sounds great. And then I guess our investors, they like to know, typically, do you plan to provide the investors with the options to 1031 exchange this investment into another one upon sale?
Always, yes. So we always give that option prior to us actually executing a sale. We normally like to wait till after the buyer has completed their DD, their money is already hard, which we normally ask for upfront depending on the current market conditions. However, about a month prior to us actually closing, where we have a good idea that the buyer's going ahead and acquiring our asset that we're selling, we notify via email and asking investors if they would like to go ahead and liquidate their proceeds or 1031 their capital into a new deal. And then at that time, we also give an estimate on what they can expect to return when it comes to capital.
That's awesome. That's great. And then I guess as the GP team, how much is the GP team investing in this deal?
Right now, the GP team's investing around $1 million.
Okay. That's great. That shows skin in the game, on the part of the general partnership team, that they too have their own money in this investment, and that they're not only incentivized to do well for, themselves, but also for the investors, for everybody involved. All right, final question. Can you guys summarize, just for our investors, all the conservative points of this deal? I know you mentioned so many throughout the presentation, but if you can just kind of summarize what those points are and why it makes sense to invest in this particular deal at this particular time when we're seeing high inflation, a possible recession, and of course, rising interest rates.
Yeah. Elijah, you want to take it away?
Absolutely. And I can talk about this all day, but I'll try to keep it short. We've mentioned a few of the main points, right? We've mentioned, break-even occupancy being at 70%. We've mentioned that our payroll expenses are going to go up. That's probably pretty conservative. We've mentioned, 36 months for both loss to lease ramp downs and for renovation schedules. Expenses are growing. We underwrite conservatively, and the pro forma that we present is conservative in really so many manners. But I think, to me, one of the best ways to look at it is this. For so many deals, they will provide a pro forma and say, this is the plan of where we're going to go. And if it hits this plan, these are the returns we're going to get. The way we think about it is different. We say, here is our plan, but how wide can we go and still keep those returns in the same ballpark, right? How flexible is the deal? And so we make sure going in to structure the deal that gives us flexibility. I think that's presented in the debt. And we make sure to buy off of fundamentals. So we buy in markets that have supply-demand dynamics where there is not enough units being built, right? And you cannot build anywhere else, right? Where incomes are strong. We buy in places where we don't have to predict. We don't have to try to guess where the market is going to go. We know fundamentally that the market has the basis to grow. And we make sure to buy right initially and then let the structure the investment so it's flexible to weather any storm and to provide returns in really any scenario. And so lastly, I would say, to the inflation point, this is a prime example, right? We know that, or we suspect that inflation will continue to rise. And, historically, the Fed's response to inflation rising has been an increase in interest rates. And so there's really two ways that this can go. I don't sit here and try to predict. Inflation could continue to rise and the Fed can continue to increase interest rates. What are the pros and cons? The cons are interest rates continue to rise. There's less liquidity in the market, which means, sellers aren't able, or operators aren't able to sell at the prices they once were able to sell at. Well, we're okay with that because we have flexibility of exit. We have this thing for the next 28 years if need be. We won't need to do that, but we have this thing for forever and we have a fixed rate. And so we have flexibility. We can exit whenever we want. The good news, though, is that if inflation continues to rise, that's going to present itself in rents. And so we should get higher rents than what we're projecting if inflation continues to rise. Second way, and I promise I will finish, let's say inflation doesn't continue to rise and rents don't continue increasing at the same pace. That's the con. You don't get the same rents. The pro is that in response to that, the Fed will try to stimulate the economy and they'll start decreasing interest rates. That will bring a lot more capital, a lot more liquidity back into the market, both on the debt side and on the equity side. And it will allow buyers to get better proceeds and get more equity to buy these deals, which will shoot up the prices for the properties through cap rate compression. So you may not be getting the NOI increase, but you are getting the cap rate compression from the flood of liquidity into the market. And we're good in that scenario as well. So we like to think, what are all the scenarios and are we built for each scenario? And I think this deal is a prime example.
That's awesome. Thank you so much. And so, I think like this point, this is precisely why I said we like this team, because we feel like they're very thoughtful in, how they think through this investment and the business plan. So kudos to you guys for being very thorough on everything.
Thank you.
Of course.
Yep. All right. Well, thank you so much, guys. We are honored to partner with you guys on this opportunity. And we can't wait to see the transformation happen at Verdir at Hermann Park. I'm sure it's going to look beautiful, the clubhouse, the common areas. So we're looking forward to seeing the transformation. And thank you to our investors for tuning in and to our investor presentation on Verdir today. Please don't hesitate to reach out with any questions. Here is our contact information. If you should have any questions or if you need any assistance making your investment in the InvestNext portal. Take care, everyone, and we'll talk to you guys later.
Thanks so much.
Take care. Bye-bye.
Thanks, guys.